Let's think about these 3 key points now. Prudent. This means, do you understand the investment, the people, the returns, the risks, and the rewards? Do you really know what you're doing and whether this works within the pension rules, and importantly, which rules? A prudent trustee always carries out due diligence without question and to the best of their ability. If you don't have the skill to do the due diligence, you should always consider what support is needed to make sure you are acting prudently. Commercial. Is the investment in line with at least a comparable market rate of return and risk? Although it is down to you as the trustee to determine what is commercially acceptable to you. This can mean making sure that the purchase of assets from connected parties is done at arm's length, for example. Or whether assessing a bridging loan where the rate of return is lower than the equivalent that a bank might offer is commercial enough based on the risks and the loan terms. Secure. Not to be confused with secured, although it could mean this too, but have you done everything you can do to de-risk the investment and protect the SSAS? That might mean a wide variety of things, but it starts with being able to understand the investment and therefore what the risks are. This means investment risk in general, and particularly project risk, but finally, and by no means least, the tax and legislative risks. These key principles apply to any type of investment you might make, whether bridging to others, borrowing your own money, or buying. If it helps, you can think of it in a slightly different way, and we call this our 3-tiered due diligence process. Tier 1. Who, what, where and how. This is the prudent bit. What is the investment? Who are the people? What are the returns, exit strategy and contingencies? What does the financial background look like? What entity are you bridging with or buying into? It's also here where you assess whether or not the investment you want to make fits within the pension rules. It's the baseline of your whole process and arguably the most important stage. So you might need to call on education, support and connections to get this all done. When you're clear on the who, what, where and how, you can move on to Tier 2. Tier 2. Does the deal stack up to being commercial in nature, or would you struggle to do this deal outside of the SSAS? That's the commercial part. That might mean assessing what rate of interest you should charge on a bridging deal, depending on the deal terms, or whether your interest rate when borrowing money yourself fits with the rules, but also isn't too high that it could be questioned. It's also closely linked to Tier 3, so let's move on to that now. Tier 3. This is where you assess the risks of the deal, the rewards, the return and the tax dangers, and establish whether the investment can and should go ahead based on what you can do to de-risk. This, of course, is the secure part. These two things aren't always the same. In fact, sometimes they can be complete opposites. Something you can do shouldn't always necessarily be done. So it's for you as trustees to determine firstly if something does meet the rules. You do that in Tier 1. But it's in Tiers 2 and 3 that you assess whether you should do it, either in the way it has been proposed or in a different way, what the risks of both routes are and which is more prudent. In other words, which has less risk or what risks can be managed and mitigated. These are all fluid decisions driven by the type of investment, your own investment mandate, skill and experience. Again, you might need to call on a combination of education, support and connections in these tiers too. Once you've really understood the risks, you should do your best to de-risk. That might mean taking security, changing the structure of a deal, increasing the returns to make the risk-return balance more suitable, or any other combination of things. But it's the final step in the process before hitting the go button with your independent trustee. From here, once you've completed due diligence on all 3 levels and you're sure the investment is prudent, commercial and secure, you can proceed to the formal board vote. The relationship and style of your independent trustee and any other co-member trustees, if you have internally collaborated, will always determine how much due deal falls to you, other members of your SSAS and your independent trustee. If you have used a tool like Wealth Dynamics to understand individual skills within a team or collaboration, then it's here that you might assign particular tiers to members or particular tasks within any of the 3 tiers to any one member. Your independent trustee may insist on doing some of your due diligence, and that will depend largely on the relationship that you have with them. However, no matter what your dynamic, experience or skill set, there will always be an element of responsibility on you, the member trustee, to make sure that the due diligence you do is accurate, accountable and present. You should always keep good audit trails of communication, files detailing the due diligence that has been carried out, by whom and when, and where possible seeking the help of independent specialists to ratify any decisions you make. Calling on specialists might be more common than you think. Buying a property, for example, will require the services of a solicitor, certainly, but quite likely a financial broker, various types of surveyor, and most likely a selling agent or sourcing agent, depending on your own skills. It's also possible to outsource most or all of your due diligence to a third party if you prefer, much like directors of a company can choose to outsource their financial or record-keeping responsibilities to an accountant or bookkeeper. It removes the actual act of accounting or bookkeeping from their day-to-day lives, but it doesn't remove the responsibility of making sure that the company accounting is done and within the legal framework required by HMRC and Companies House. In that same sense, any outsourcing the Board of Trustees decides doesn't remove the responsibilities from the member trustee, you. It's still the Board of Trustees and quite possibly you, the member trustee, that must check that thorough due diligence has been completed, because remember, not all independent trustees will check your due diligence or do their own. So, there's the principle of due dil covered. But we know that you're keen to understand how to do great due diligence, and so we're going to give you a solid framework that you can use time and time again. After all, we want you to nail this every single time. So, what else do you need to do? Well, there are some fairly obvious things that all trustees must do. You should act in the best interest of all members at all times, even if you are the only member. Remember, you wear 2 hats when you have a SAS, the trustee with executive oversight and responsibility, and the member, whose money is being invested and who stands to lose if things go wrong. But you might be part of a team SAS with many members, and you are all equally responsible for each other in this case. You must act legally. That means avoiding pension liberation, fraud and dishonesty. You should ensure that complaints from members are dealt with quickly and accurately. You must make sure that the scheme's reporting and regulatory responsibilities are being carried out, even if that's outsourced to a scheme administrator. You must also take continued professional development relevant to your role as a trustee and your investment strategy. Overall, it's an almost identical role to the director of a limited company. These are mostly generic executive tasks, most of which are common sense. But when it comes to investing the SAS funds, quite simply, you must always act prudently, be commercial and secure.